In the last session, we have learned the basics of fundamentals and something about capital. That is, capital is a liability, how to prepare an account. In this session, we'll prepare the capital account under fluctuating capital method and fixed capital method, as we have learned earlier. Capital is a liability. What is the American system rule of liability? Debit, decrease in liability, credit, increase in liability. So now, when you prepare the capital account, if the capital balance increases, will credit capital account. If capital balance decreases, will debit capital account. So let us take up one full problem and see these two methods. Before we start with the problem, fluctuating method. Fluctuating means, now see, when the capitals are invested by the partners at the beginning, that capitals will not remain same till the end of the year. They fluctuate. They fluctuate because all the entries are taken in capital account only. Whatever the partners are receiving or whatever partners are paying it to the firm, everything is recorded in capital account, and that is the reason capital will fluctuate. It will change. Fixed capital method. What capital we invest at the beginning should remain same at the end of the year. If it should remain same, then the question is, where are these adjustments to be taken? For that, we prepare one extra account called as partners current account. This is the second method. First, let us concentrate on fluctuating capital method. The first problem: A and B are partners in a firm, contributing capitals 50,000 and 40,000. Right now, there are no capitals. When A and B contribute capital, capital comes in. Capital comes in the business means capital balance will increase. Increase in the capital balance is nothing but increase in liability. Let us credit that. So the capitals brought in by the new partner, we record that as by balance brought down. A is contributing 50,000, B 40,000. Next, now see the problem further. What is given? The partners are entitled for the following. First, interest on capital is allowed at 6% per annum. Interest, partners invest the capital, so firm has to give them the interest. So when firm gives the interest to the capital, it's but obvious that the capital balance of the partners will increase because they are getting the interest from the firm. Increase in the capital is increase in liability. We'll credit that by interest on capital. It is at 6% per annum. 50,000 of that 6%, what amount we get is 3,000. 40,000 into 6%, what we get is 2,400. Next transaction. Partners are also getting some salary. What salary they are getting? A 15,000, B 10,000. That is per annum. When partners receive anything from the firm, their capital balance will increase. What partners pay to the firm out of their capital, that time their capital balance will decrease. So here, partners are receiving salary. So again, capital balance will increase. Increase in capital, nothing but increase in liability. Let us credit that by salary. The salary what the partners are getting is per annum. If it is per month, we'll multiply by the number of months and take the amount. Here, directly we'll show it as A 15,000 and B 10,000. Next, commission to A 5,000. Again, A is getting some commission. So capital balance of A will increase. Increase in capital balance is increase in liability. We need to credit that only in the column of A. Commission. By commission, A is getting a commission of rupees 5,000. Next, profit as per profit and loss appropriation account amounted to rupees 20,000. Appropriation account, profit is given 20,000. We should distribute among the partners and transfer it to capital account. So again, when partners get the share in the profit, capital balance will increase. Increase in capital is increase in liability, will credit that by profit and loss appropriation account. Now, when we have seen the problem, it was mentioned that A and B are partners. Have they given the ratio? In which ratio the profit must be distributed? No. So, as we have learned in the last sessions, when profit sharing ratio is missing, it has to be the equal ratio. So, this 20,000 will be distributed among A and B equally. We'll specify here profit in equal ratio 1:1. So 20,000 when you distribute equally, what you get is 10,000 rupees each. Next, drawings are given. Drawings for the year A and B, how much they have withdrawn? 10,000 and 5,000 respectively. Drawings means what? Amount withdrawn by the partners from the partnership from business for their private use. So when they withdraw the money out of the capital what they have invested, it's but obvious that their capital balance will decrease. Decrease in capital is decrease in liability. Let us debit drawings. On the debit side, A 10,000, B 5,000. Next, interest on drawings on the same amounted to rupees 200 and 100. Drawings amount withdrawn. So naturally, interest on drawings will also reduce the capital because that is the interest what partners have to pay to the firm. Understand this point neatly. Drawings, now say for example, loan taken from the bank. When we take a loan from the bank, we repay the loan back along with the interest. Similar, when the amount is withdrawn from the business, you have to pay the interest along with the amount withdrawn. So what you pay will reduce your capital. How much is the interest on drawings? Rupees 200 and rupees 100 on to the debit side. To interest on drawings account, rupees 200 and rupees 100. Now, that's all. This is what is the problem given, and this is what the fluctuating method we have done. Now, let us balance this and see what balance we get. Your credit side is more. 53, this is 20, 73 and 10, 83,000. This is 20, 40, 60 and this is 62,400. The way we balance our ledger account. Write the balance on both the sides. From this total, let us minus this. 83 minus 10, 73,000 minus 200. What you get is 72,800. 62 minus 5, 57,400 minus 100. 57,300. We show it as to balance carried down. Now, which method is this we have learned? Fluctuating capital. fluctuating. What I said, what is fluctuating? Capital at the end will not be same as compared with the beginning. 50 and 40 invested, is the capital same? No, it changes. That is what is fluctuating capital method. It changes because all the adjustments are done in capital account. Now, in the same problem, let us see this fixed capital method. Same concept. Increase in the capital, increase in liability, we credit. Decrease in the capital, decrease in liability, we debit. The only change is, these adjustments what we record, the adjustments like interest on capital, salary, commission, profit, drawings, interest on drawings are not to be taken in capital account. Then the question is where they are to be taken. For that, we open a separate account called as partners current account. In capital, only capital. Let us see. There is again no need to go through the entire problem. From this capital account, we can post it under fixed capital method. Let's see. By balance brought down, A 50,000, B 40,000. Now whatever are the adjustments like interest on capital, salary, commission, appropriation account, everything will come in current account. Again, there is no need to see the problem whether capital should be debited or credited. Already we have seen. Even in the exam, don't waste time for this. You have seen that capital has increased. So we have credited. Here also it will be same. So what all we have, the adjustments in your current account. What is the first one? By interest on capital, 3,000 and 2,400. The rate of interest 6%. Next, partners have received salary. So capital has increased on the credit side, 15,000 and 10,000. A has received commission. Whatever is received from the firm will increase the capital balance here. Next, by profit and loss appropriation account. Profit in equal ratio. Let us take it by profit and loss appropriation account. It's 10,000 and 10,000. You can specify into bracket profit in equal ratio 1:1. Then once you finish this, you have taken drawings. As we have learned, as we have seen in this fluctuating method, drawings will decrease your capital. Interest on drawings will decrease your capital. That is the reason why we have debited that. Let us debit it in current account. 2. Drawings account, 10,000 and 5,000. Let us below that record the interest, the amount 200 and 100. That's all. This is fixed method. Only the basic what you want to remember is what partners receive from the firm, their capital balance will increase. Increase in capital, increase in liability, we credit. What partners pay to the firm will decrease the capital. Decrease in capital is decrease in liability, we debit. Now, let us balance your accounts. 50,000, 40,000 total. When you balance it, do we have anything to minus here? No. So the balance what we get here is 50,000 and 40,000. We show it as to balance, carry down. Fixed capital method, what is the capital at the beginning? 50, 40. At the end, same. That is fixed capital method. To keep the capital fixed, we open one current account. Now let us balance this current account. Check out which side total is more. Credit side total is more. Let us total that. This is 10, this is 20, 30, 33,000. This comes to 22,400. Write it on both the sides. 33,000 and 22,400. From this, minus the debit side, we get the balance. 33 minus 10, 23, minus 200, 22,800. 22 minus 5, 17, 17,400 minus 100, 17,300. We show it as to balance carried down. This is what we carry forward in the balance sheet. Balance carried down. So this is fluctuating and this is the fixed method. In this session, we have solved one problem on fluctuating as well as fixed. In the next session, we'll take up the second problem on fixed and fluctuating method. Thank you.